freely available to access. So what we are saying is trade statistics or the ratio or a trade as a percentage of GDP basically looks at the interdependence of one economy on the other and what is the dependence of the economy's growth on the trade. That is how much percentage of GDP is trade contributing. So in this case, when we look at the graph here, we can see the percentage and we can normally see that these East Asian economies which have very little natural resources are heavily dependent on the trade. You can see here that the dark blue color, that is more than their GDP. So they import, their imports and exports are very heavy as compared to the GDP. So this is the percentage, trade percentage of GDP. You can see that mostly the economies range between 50 to 80% of the GDP as they trade. And as I already told you, this is imports plus exports. So if the economy is heavily importing, that also means that their trade is a very high percentage of the GDP, and that's why you see that the percentage is more than the GDP, that is 161. That means that their dependence on the trade is very, very heavy. So you normally, I'll come to the regional analysis also. So you'll get an understanding as to which countries are heavily dependent on trade and which regions are heavily dependent on trade. So as we can see here, the graph, this is the second graph, which is the trade as a percentage of GDP. This is the growth rate. So you can see that over a period of time, how the trade as a percentage of GDP has increased. So in the world, this is the world data, average world. So you can see that in 1970s, it was on an average less than 25 to, it was between 25 to 30%. That means on an average, the trade was very less on an average in all the economies put together. This is the average, world average as a percentage of GDP. And as and when the economies started opening up, I have already discussed this with you, that the economies were following a lot of protectionist policies, and later on the organizations had to intervene, and especially the restructuring of the economies were were asked for by these organizations like IMF and World Bank. So you can see here, from here the slope is so steep. That is 1990s, just before the 1990s, in the middle of 80 and 90, all the economies, you can see here, suddenly there has been a sharp increase in the growth of trade, and this has become more than now 60%. And then again you can see the crisis in 2007, which I had discussed the other day. You can see a dip here in the trade, and then again slowly there has been recovery, and again you can see in 2020 there has been another dip. So now the world is again recovering with respect to the trade. So this also is another figure which is following the trend which I had discussed in the previous graph, exports of goods and services as a percentage of GDP. So this also follows the similar trend as the previous graph. The previous graph was total trade, imports and exports. This is only exports. So when you look at the next chart, that is world trade in goods and services from 2012 to 22. So this is the annual percentage change that you are looking at. So what is significant in this is that there has not been a steady trend in the world trade. So there has always been fluctuations in the trade, and you can see here the deep dip that has taken place both in the goods as well as in the services. The red line is the services and the purple line is the goods. So, but there has been a rebound. That's what is the analysis, that post pandemic there has been a rebound in the both the goods and the services in the world. So when you look at the trade in goods and services in 2022 was this is the world trade around 31 trillion dollars, and this is the 13% year on year rise. So goods exceeded the pre-pandemic level first, and then the services caught up. So you can see here that during the pandemic it had dipped, and now slowly it is picking up again. So when you look at which countries are in the world are top exporters exports in the world, you can see here the red one is the Chinese economy. So you can see here China remained at the top of merchandise exporter in 22, but its share in the world exports declined to a small extent. United States is almost half the 8% of the world trade, and Germany just follows it. They were ranked in second and third position. So you can see the Chinese merchandise trade. China stands the number one. Merchandise means the goods, manufactured goods. In that, the Chinese are contributing almost. You can see the share is 14%. So it is quite a big percentage which is contributed by China. Similarly, when you look at the manufactured goods and other goods, manufactured goods are having a higher share as well as the higher growth rate. So when you see the comparison between the intra-regional merchandise trade, what you see here is European continent, and when you say Asia, because China is there, that's why you see that intra-regional merchandise trade 65% of the Europe's world trade, and it is highest in that region and lowest in African region. So this black line that you can see, or navy blue line that you can see here, is the African region. So highest trade, intra-regional mercantile trade takes place in Europe and Asia, and the lowest takes place in Africa. So who has the highest share of the slice? If you that we have already seen the top three, China, US and Germany, which I had shown in one of the previous slides. You can see that nowhere in the exports India is there in the top 10. So India is not in the top 10 exporters. There are other countries which are having higher shares, but China outstands all the other countries. When it comes to the importer, US is the largest importer in the world, more than the China. So US runs a very huge trade deficit because its exports are less than its imports, and that's the reason why US economy is so important for the world, because it imports very heavily from other countries. That's why they say that when US sneezes, the world catches cold. The reason is because if it stops or decreases or reduces its demand for the world goods and services even by a small proportion, that is 0.5 or 1%, it makes a huge impact on the other countries' growth because US demand for other world goods is very high. So you can see here US is the top importer, and India also imports very heavily. So India is among the importers, top 10 importers, but it is not in the exporters category. So the world merchandise trade by region, again, this is the world data, and the highest growth that you can see is achieved recently by the Middle East. This is the growth rate that we are annual percentage change, that's what we are talking about. This is we are seeing that the Middle East is actually entering into a lot of trading in the recent times. So when you look at the merchandise exports by major product groups, so which products basically is getting imported and exported, if you look at that, you see that the manufactured goods play a very important role, followed by fuel. So the proportion or the percentage has not changed much pre-pandemic and the post-pandemic. Manufactured goods only contribute very heavily towards the merchandise exports. So fuel also is contributing very heavily. Coming on to the commercial services, again, this is just a graph to show that how the travel industry got sharply affected because of the pandemic. So you can see here 2020 was the pandemic year, and this purple line is the pandemic travel in the services. So you can see here it had completely dipped by -60% during the pandemic year, and suddenly it has rebounded. So what you can see here is post pandemic, the travel has exceeded the other services. That is, this is the other commercial services, the yellow line, and the red line is the transport, which is linked to the travel. So transport and travel are playing a dominant role in the services export, that is, sorry, world trade uh, uh, in a post pandemic period. So you can see here travel has increased by 91% compared with 2020. So we can also see that many people across the world, whatever was the pent up demand, suddenly has started increasing. I'm sorry. So among the other commercial services, we can see here the growth rate is highest among the computer services. So India has risen to the 7th position in the ranking in the service sector, which is double-digit growth rate because of the it had a lot of exports in the computer services. So this is something to be noted. So among the least developed countries, we can see that the exports of goods from the least developed countries has reached the $277 billion in 2022. So there has been a tremendous growth in the goods market in the least developed countries. So this is also something worth noting, that the least developed countries exports of goods is increasing very heavily post pandemic period. So what we can say is about the outlook for trade is that the trade and output growth had slowed down and remained weak because of the Russia-Ukraine war. And now again, because of this is the 22 data, that is the one which is available. But in the recent times also we can see that because of the war in the Middle Eastern countries, again the trade has dipped very sharply. When we come to the slowdown in the fourth, that is, it has continuously declined because of the high energy prices and rising interest rates, which has dampened the consumption and investment. These are some things which are self-explanatory. So as far as the volume of trade or the value of the world exports are concerned, that is also not increasing much because of the prices of energy, which was there in the last slide. Whereas the commercial services are growing faster, and there is a fast recovery from the pandemic period. So the outlook for the next, that is for 22, this was the 22 data, so they have given the outlook for 23. Because of the geopolitical tensions, that is the Russia-Ukraine war, and presently, though this is not the present situation, but in the present situation, again the geopolitical tension in the Palestine-Ukraine region, the food and energy insecurity, that is the rising energy prices and the increased risk of financial instability and very high levels of external debt. So if we look at again the merchandise trade, the same feature appears here also, that in 2020 there was a negative growth both in terms of the mercantile trade volume. By sector, if you try to see the fuels and the mining sector, mining products are showing a very high growth, whereas the manufactured sector, you can see here the growth rate is very low. When it comes to regional aspects of trade, again, what you see there is that there has been this is the world growth in the exports by region, and you can see, which I had shown earlier also, this is exports. The earlier one was the trade data. So Middle East is showing was showing very high growth rate, but of course this is the period which is, that is the other industrial Commonwealth countries. In case of imports, it is the South American economy that is having very high imports. So having talked about the world, last slide on India's global partners, trade partners. So what you see here is, if you want to decompose Indian trade, this is the Ministry of Commerce. All figures are in lakh crore rupees. So here you see that India, the import, this is trade, okay, not just exports and not simply imports. It is imports plus exports. So together we see that USA has been the largest trade partner of India, and UAE definitely, because we import heavily the fuel from the Middle Eastern countries. So we have around 1.2 lakh crore trade with China, followed by Bangladesh, UK, Saudi Arabia, Germany, Indonesia all contribute to a very small proportion of the total. So majority of the trade is between these four countries: USA, UAE, and Netherlands and China. So that is all about the trade data. So having talked about the trade between different countries, this basically I tried to explain the trade. As I already told you, the reason why we explain trade is to give you an understanding about that all economies of the world are economically related through trade, and their interdependence is shown, that if a small percentage change in the domestic policies takes place, or internal policies changes in these countries, it has severe effect on the world trade as well as trade between nations. So that is the reason why we try to briefly understand the impact of the trade the trade statistics over a period of time. So, what is the significance of international trade? Definitely, we know that uh, one nation is interdependent on other nations. So when we say that the economies are interdependent, we also understand that there is economic growth which is going to result in increase in the import. Now, what do we mean by this? Basically, we are trying to say that when the economy grows, both its imports and export will increase, but only its import is going to be important for other countries, other developing countries, because increased import will stimulate economic growth of other countries. What do we mean by that? Suppose US economy grows by every year, the GDP growth of United States, for example, is 2.2%. Now, as I have already shown there, that 10% of the world imports are coming only from the United States of America. So when the GDP of America increases, it is definitely going to have a higher demand for goods and services from other countries. So when there is an increased demand for goods and services, there is what we call as foreign trade multiplier that comes into existence. So if you remember macroeconomics, there we had studied that when the income increases, partly the income is spent on domestic goods and partly it is spent on imports in an open economy. So, if the higher proportion of goods are spent on uh, the imports, then what you are doing actually, you are exporting economic growth to other countries. So, understand this point, that when you are increasing the demand for imported goods, it is stimulating economic growth of other countries, because the other countries goods and services is being demanded by you. So if you grow, you are exporting economic growth to other countries. Now trade becomes very important there, because the economies get not only access to the items that are not domestically available, but also you get the goods at a lower cost. You also get the variety of products which normally is not available when your economy was closed. And what you are trying to look at here is that you are trying to say that when you trade with the other countries, it is not just the trade that happens between the two countries. What actually happens is there is a lot of interdependence which is beyond trade. There is a lot of diplomatic ties that takes place. There is a lot of cooperation which is unwritten cooperation that takes place, because you know that if you don't have good political ties with the other countries, then your trade will get affected. It can be imports or exports, and if your trade is getting affected, you have seen how heavily is the percentage of trade to GDP with respect to all the countries of the world. So if your trade gets affected, your GDP also will get affected. So countries normally would like to have a cordial relationship, diplomatically good relationship with the other countries with whom they have trade relations. So Here, if you remember macroeconomics a bit, there we had, if you remember it, we had studied that when what was it, Mundell-Fleming model, where we had basically looked at beggar thy neighbor policy. How many of you remember that beggar thy neighbor policy? Does anyone remember? Anyway, you're going to write, some of you are planning to write your ATKT, so you might have brushed up the basics again. So can someone tell me what is that beggar thy neighbor? The last 2 points on this slide I'm basically trying to look at, that fiscal policy and monetary policy, which is basically a domestic policy of any country, affects international trade. So I'm just trying to make you recollect the policy that we studied in the Mundell-Fleming model. What was the policy? It was the beggar thy neighbor policy. So can someone tell me what was that beggar thy neighbor policy, if you remember? याद आ रहा है कुछ कि ऐसा लग रहा है पिछले जन्म की बातें हैं? What was the beggar thy neighbor policy? Anyone? Briefly also will be fine. What had happened, what do we mean by beggar thy neighbor policy? That when an economy was trying to solve its domestic problem of unemployment and growth. Remember the quadrants that we looked at? We said that the economy is facing unemployment. So to solve the problem of unemployment domestically, what does the economy do? The economy tries to expand, have an expansionary monetary policy. So when there is expansionary monetary policy that is being followed by any economy, it is actually exporting unemployment to the other countries, because you are trying to solve your problem by making the other countries poorer. So that is exactly what we looked at when we talked about beggar thy neighbor policy. So basically what we are trying to say is that when we are in a closed economy, when we are trying to solve the problem of unemployment or overemployment, what we are trying to do, we are trying to use monetary and fiscal policy to solve these problems. But the entire chapter that we did on open economy macroeconomics was basically the fiscal and monetary interventions that the economy uses in an open economy to solve the dual problems of deficit or surplus in the trade, and the unemployment or the overemployment, or it is trying to solve the problem of higher prices, or when we say deflation, inflation or deflation. So what is the policy here? The policy is trying to target the domestic problems. But when these policies are being followed by the domestic economies, it is having an impact on the other economies also. So that is the reason when we, I gave you a case in example, that is the beggar thy neighbor policy. Otherwise also, solve our deficit problem, we are trying to reduce the imports and increase the exports. So if we are trying to reduce the imports by following contractionary policies, then what is happening? We are imposing barriers on trade. We are trying to increase tariffs. We are trying to ensure that imports are becoming costlier. So when we are raising those barriers, who is getting impacted? It's the other countries. Our trade partners are getting affected. So what we are trying to look at in this slide, the significance of international trade is that all the nations are interdependent that is interdependent through trade. Trade is beneficial because it helps the economies in getting the goods at a cheaper price. We get variety of goods, and we also get the goods at a very competitive price. But at the same time, trade is making two countries interdependent beyond the trading aspects, that is politically as well as diplomatically. And the policies also are affecting each other. It is the not only the trade policy that is affecting other countries. Effectively only trade policy should be affecting other countries, but because of international trade, even the domestic policies which are targeted to solve the domestic problems of inflation and lower growth rate, those policies also are affecting trade. Is that clear?
Yes, ma'am.
Yeah. So that was the signal. And so what we are seeing here is when we talk about interdependence in the world economy, it is reflected in the form of flow of goods, services, labor and capital across the borders. So this is goods and services, which we call as the trade, basically in goods and services. Then this is the factor labor and factor capital which is taking place. So normally we see that this is the gravity model which we don't have in our syllabus, but just briefly what we are trying to say is the interdependence is basically determined based on the gravity model. So gravity model is basically derived from the physics subject. We all know the law of gravity. The closer the object is to the gravitational force, you see that the pull is very high, and that's how we are trying to measure trade. So here we are saying that in the trade, we are expecting that the nations will trade more with larger nations, that is with larger GDP than with smaller GDP. Definitely the demand is determined based on the GDP. Similarly, nations which are geographically closer with each other, the trade is supposed to be higher. This is basically because of the transportation cost. That is the third point here in the gravity model is that the nations with more open economic systems are going to have higher trade, that is those which are following more market based economies, and nations with similar language and cultural background than with nations that are different, because taste and preferences will be similar and the products can be sold across different countries. Now these gravity models have been tested a lot. There have been several PhD theses and several research work that has been done on this gravity model. So they take several variables like the distance between the two countries, the GDP of the country, and the dummy variable economic systems, and a dummy variable on language and cultural background, and try to test the proportion of trade between these countries with these variables. So this I have already explained to you in my introduction, that there has been an increased international flow of labor and capital. and what is the impact of migration, what is the impact of free flow of capital, uh, and other aspects. So coming on to what we are going to study in the first module, what you find here is that the purpose of the economic theory is more to predict and explain. Okay, so why do we study the theories of trade? Basically, to predict and explain what might happen if the trade between the two countries are taking place. Now remember that all economic theories are based on assumptions. So we start with a basic model of two nation, two commodities. Okay, and we first start with one factor and then we go to the two factor model. So all our theories that we are going to study in module 1 will be basically dealing with two nations. We call them nation nation 1 and nation 2. In some of the textbooks, it is given as nation A and nation B. Then we study two commodities. So it is called commodity X and commodity Y. And the first few theories are one factor theory, that is, we use only labor, and the later theories in the module will deal with two factors, that is capital and labor. So what is the basic assumption that we are going to start with is that there is no restriction of trade. That is, we are talking about an economy where there is no government intervention in trade. All the economies are trading, are existing in a free trade market. So we are also talking about perfect mobility of factors within the nation, but no international mobility. This point I will explain when we reach that model, because it will be a little confusing to you to understand this particular assumption here. When we reach that model, I will explain this assumption. So the next assumption that we are normally doing is the perfect competition in all the commodities and factor market. The implications of this I will explain when we reach the model. And definitely we are always talking about no transportation cost, because we are looking only at the cost of production and not the cost of transportation to determine whether the trade is going to take place or not. So we start with simple models with these restrictive assumptions, and then we relax one by one the assumptions. That is, we start with a very basic model and then we say, okay, this model has a flaw. So let us relax one assumption and go to the next model. So all the models are interconnected. That's the reason why you should understand from the basic, because without understanding the basic, it becomes very difficult to understand the next model, because each of these models are interconnected with each other. So what is the reason why we are studying this model is to find out the basis for trade. Now what we are trying to understand is two aspects in trade. The first one is called basis for trade. Can someone tell me what is basis for trade by your understanding? To put it in simple language, it means why trade should take place between two countries. Now, I am an economy, Indian economy. I am producing, say, 1,000 goods, 1,000 different types of goods, right from safety pin to maybe certain components of spacecraft. So I am producing thousands of goods in domestically in my country. But I don't trade in all the commodities that I am producing. Some I sell only domestically, some I sell it to the other countries, and some of the goods I import from other countries. Now the trade theories are trying to explain me what is the basis of this trade. When I say basis for this trade, why is trade taking place between the countries? When I say why is the trade taking place between the countries, definitely the answer, the logical answer comes is because it is profitable for me, it is beneficial for me to import certain items, and it is beneficial for me to export certain items. So it is a logical thing that we are talking here, which has the economics basis. That is, if it is not giving me any benefit, I won't trade. If it is giving me benefit, I will trade. It is as simple as that. Then once we establish that these are the commodities which I'm going to trade, these are the commodities which I'm not going to trade, then the second question comes is, what do I gain from that trade? That is, how much I have to measure what I am gaining from that particular trade. So I will trade only if it is beneficial for me. That is the basis for trade. And once I trade, I have to measure what is the gain that I am going to get from this trade. Now the gains of the trade basically can be for different sectors. That is, it can be beneficial for the laborers, it can be beneficial for the capital, it can be beneficial for the consumers, or it can be beneficial for the producers. So once I establish that there is going to be benefits from trade, I have to measure those benefits from trade, and then I have to see whether which segment or which section of the society is benefiting from that trade, or how is the gains of the trade measured, and then how it is getting distributed. So we are trying to find out these. Then when we go to the third module, third and fourth module, we are looking at what happens when there is trade restrictions, the policies that are directed at regulating the flow of international payments and receipts, and how it affects the nation's welfare and welfare of the other nations. So broadly, if you look at the international economic theory, your concepts of macroeconomics and microeconomics are extremely important, because when we deal with the nations at an independent level, that is individual level, we use a lot of microeconomic theory of demand, supply, price, factor prices, commodity prices, relative prices, etc. When we compare the countries, two countries with each other and try to measure the welfare gain, we move into the domain of macroeconomics. So international economics uses both microeconomics and macroeconomics to a very large extent. So I have already, that's what I have written here, microeconomics and macroeconomics aspects, a lot of it is used to determine. So I have already explained this to you, so I'm just going through the slides very quickly. So the subject matter, as I've already discussed in the previous class, that it is a subject that is developed over 2 centuries. So I have already explained this to you, basis and gains from international. So what is the first part? The first part, we are going to deal with international trade theory, and it basically looks at the microeconomic aspects. Then we look at the trade policies in the third module. I have already explained this to you in the last lecture. So this is the second part, which will be looking at the trade restrictions and the implications. So when we do trade, definitely someone has to keep an account of the trade. It is done through the balance of payments and various approaches to balance of payment balance. So we'll look at it in the fourth module. Similarly, we also look at the foreign exchange markets, because Domestically, the trade takes place in domestic currency. When we get into international trade, our initial models do not get into exchange rates. We assume the exchange rates. We assume exchange rates, and then we look at only the cost of production as the basis of trade. But we all know that in practically, when we study international economics, or when we want to actually find out whether we are able to import or export, our competitiveness strongly depends on the foreign exchange rate. So this part, that is, there are two segments which I'm leaving to you for self study, because this is very basic, and I'm sure you will be able to understand it from the textbook. This is given in the introductory chapter of Salvatore. What are the international economic problems and challenges that are faced by various economies? So it is given under different headings and very nicely explained also. So if you read it, you will definitely understand it on your own. So this is one part which I would like to leave to you for self-reading, because now it's high time that you start focusing on your self-reading also. So international economic problems and challenges, you find that broadly, I have explained this here and there, but this is given in a systematic manner. So what are the problems and challenges? Like slow growth, high unemployment, lot of trade protectionism in the industrial countries that is taking place in the recent times. Similarly, there is lot of fluctuations in the exchange rate and the financial crisis. I have explained this to you here and there in the introduction, but this is given a little more systematically. Similarly, there is a lot of structural imbalances that is taking place in the advanced economies. Like I already told you, US is heavily dependent on imports, and to finance those imports, it borrows heavily. So you find that there is very high trade deficit in the US economy, as well as US is the very high debt based economy. And at the same time, the Japanese economy, if you look at it, it's also very highly dependent on its exports for its growth. So this is something. And when it comes to transition economies or emerging economies, they face severe restructuring problems. So all of you by now understand what is macroeconomic stabilization and restructuring, which we had done in the first chapter of macroeconomics. Besides all these aspects, one of the biggest challenges that the world is facing is in the form of deep poverty. In spite of having very high growth rate of trade in the world, we find that there is a lot of international inequalities in the standard of living. Even today, a substantial part of the world stays below the poverty line, that is below $1 per day wages. So, and there is a lot of unmanageable international debts that is also a cause of concern. From the supply side, we find that there is rigidities because of the rising price levels, climate change, and environmental degradation. So this part, you please read it from the textbook. Okay. So the trade and development part I will be doing when I do the model. There is another module there where I'll be dealing with this segment of trade and development. So I'll not be dealing with it here. Okay. So what we are trying to understand here is whether trade leads to development, and is what is the importance of trade to the development, and is trade an engine for growth. So this is a very important topic which I'll be dealing later. Then this segment also, I want you to go through on your own from the textbook. That is, what are the specific problems related to developing countries. So this also is very clearly and point-wise explained in the textbook Salvatore in the introductory chapter. What is the specific problem of developing countries? These are all generic topics which does not require too much of explanation. That's why I'm just leaving it to you for studying on your own. So poverty, all of us understand the foreign debt problem, trade problems. These are all, some things related to Indian economy, which you have been studying time and again. So please read it on your own, the specific problems of developing countries. So I'll be starting with the classical trade theories, which is the second part of the module 1 and which is the most important part of module 1. So what we'll be doing here in the classical trade theories, I hope I have been clear so far. I did with the introduction. Before I start this, let me just summarize what I did in the last 1.5 lectures. I gave you an introduction about globalization, the trade-offs in globalization, and then I tried to give you an understanding about why international trade is so significant to the world. I gave you an overview of the trade statistics to show the interrelationship between different countries. And then I gave you 2 topics for self-reading. One is the problems and challenges of the economies, and the second one is the for the emerging economies. So the 2 topics that I asked you to self-study, please go through in the textbook. It is given very clearly point-wise. So you don't have to worry too much about it. These are just 1.5 2 pages information that is given in the textbook. It is necessary for you to go through it once. So we'll try and understand the classical trade theories. Now the classical trade theories that we are looking at is developed in the last 2 centuries. Okay. So it is very useful to understand the concepts of this theory. It is very useful for you to understand the concepts of the theory which has evolved over a period of time. So as I have already mentioned in one of the previous lectures, that these are the theories that have emerged from the 17th century, and till recent there are developments in the trade theories. But in the classical theory, if we look at it, it is we are ending with the Haberler's theory that has happened in the first part of the 20th century. Now, an historical, when we see the history of trade theory, it is not that we are getting into the history there. We are trying to understand the concepts and theories as it evolved over a period of time. That's why it is one of the best way to understand the theory, trade theory. That's why we have to look at the history of trade theories, not to study it as history, but to understand it as concept. So as I told you, we are moving from simple to complex theories, and that's the reason why we have to study these theories from the beginning. Okay, so let us start understanding the basic questions of international trade. This one I have already explained to you. What is the basis of trade? This is one of the basic questions in international trade. So when we say what is the basis of trade, I already told you that the basis of trade is trade. Why does trade take place? There have been 2 broad answers that have been given in the theory of international trade. One in terms of absolute advantage, and the other one is in terms of comparative advantage. These have been the 2 important explanations that have been given in the classical trade theories. What is the question it is answering? The question that it is answering is, what is the basis of trade? Why trade takes place? So why trade takes place between the countries is been answered by two theories, absolute and comparative. Then the second question which we looked at, which we are going to look at, is what are the gains from trade? This also I have explained to you, how the gains are generated, how large are the benefits, how they get distributed among the trading nations, and the models of comparative and absolute and comparative advantage show that there is increased consumption gains through specialization in production and trade. So the first question is the basis of trade that we are going to look at by looking at these theories, why trade takes place. And the second is when we say what are the gains from the trade, that is किसको क्या मिलता है अगर हम एक दूसरे के साथ ट्रेडिंग करते हैं, when we trade with each other between these countries, what is the gains that are generated, how large are these benefits, kitna what are the benefits, how they get distributed among the trading nations, that is if there are two trading nations, X gets more or Y gets more, X and Y get equal, what is the benefit that is getting distributed. Then we are trying to show, we are moving from simple model to complex model. As I have already told you, these are simple models that we are going to do, absolute and comparative advantage. In that we are trying to show that the gains of trade is in the form of increased consumption of both the goods. When the country specializes in production and trades the good, it is going to result in increased consumption. That's what we are going to show. So when we look at the international trade, also the answer that we are going to get is in the form of pattern of trade. So what we are trying to see is what determines the specialization. That is, if I say that I'm going to specialize in commodity X, so how am I going to determine whether I'm going to specialize in commodity X or commodity Y? If I'm saying that I'm going to specialize in commodity X, will that commodity be exported? Yes or no? Then we are trying to see if I'm going to specialize completely in commodity X and export it, or partly I'm going to specialize in commodity X and export it. So that is called complete specialization or partial specialization. So if I'm going to completely specialize, that means I require Y also. So from where will I get Y? Will I be importing Y? Yes or no? Then we are going to understand. If I'm going to partially specialize, then I'm going to find out how much partial specialization I'm going to do, and how much I'm going to export out of that, and how much I'm going to import from that. So these are some of the questions that we are going to answer. So we are going to do three main theories. In that, the mercantilism is a view. It is not basically a theory. It is a view which was given by certain economists in the 17th and 18th century. The first actual theory of trade started with the absolute advantage theory of Adam Smith, and then it was improved upon by comparative advantage theory of Ricardo. So today I'll just give you an overview of the first theory, that is mercantilism, and in the next lecture on Thursday I'll complete advantage, absolute and comparative advantage. So the first theory, which we call as mercantilism, has come from the word merchants. Before Adam Smith gave his absolute advantage theory, there were a group of people who wrote essays and pamphlets on international trade. And since majority of them were merchants and bankers and who were involved in trading, the point of view which was given by them was called mercantilism, or the mercantilist view on trade. Okay, so the theory that we are looking at is called mercantilism, which has been derived from the word mercantile. Basically, these were the writings that got spread in European countries, especially in England and France. And later on, this theory started getting accepted by many other countries, that this is what is the basis for trade. Now, what are we trying to understand in the mercantilism view of trade? That what do they define as wealth? That is, it's a simple thing. It's a very simple theory. Mercantilist theory says that any country which has a higher stock of precious metals is wealthy. Okay, so who is a rich country? Suppose there are two countries. One has a smaller stock of precious metal, the other one has a larger stock of precious metal. So according to mercantilism, or according to this mercantilist view, any country which has higher stock of precious metal is considered to be rich. Or what is wealth of any nation? The wealth of any nation is the precious metal that it possesses, to put it in simple words. So if any country is rich because it possesses precious metal, the second question that follows is, how can precious metals be obtained? That is, now the first view says that I am rich if I have precious metal. Suppose I have gold with me, more and more gold with me, I am considered rich. Second question comes is, how am I going to obtain that gold? There are two questions, two answers to this. What is it? Any country can have naturally occurring stock of gold or precious metal. It is not just gold, it can be any precious metal that has value. Okay, so the answer which mercantilists gave is that a country is rich if it has precious metal. Second question is, how this precious metal can be obtained? It can be obtained if it is available naturally. But we all know that gold does not occur or exist in all the countries of the world. So extraction of the naturally occurring stocks or any other minerals or metals for that matter is geography specific. It does not occur in all the nations. So that does it mean that those countries which don't have these resources are going to remain poor? No. The answer is that the precious metals need not be naturally available. You can get it through export of goods and services. So if I don't have the precious metal, what I can do? So if I don't have the precious metal naturally available to me, the second option that is available to countries is that they can earn these precious metals. Now, how do they earn these precious metals? Through export of goods and services. So what is the mercantilist view here? That wealth of nations is metals. Metals can occur naturally. If it is mined, you become rich. If you don't have the natural resources of these metals, you can earn these metals through export of goods and services, because the payment for export is made in precious metals, and If you export more, you will get more flow of precious metals into your country. And the other part of it is, since if you're importing any good, you have to make payment in the form of precious metal. So what you have to do, importing causes the metal flow out of the country, whereas export is causing the metal flow into the country. So according to the mercantilism, what they are suggesting is that the natural conclusion is that export must exceed import if a country has to become wealthy. So this is the summary or the idea of mercantilism, that a country is considered wealthy if it has more metals, precious metals. Precious metals can occur either naturally or you have to earn it. If you have to earn it, how do you earn it? By exporting the goods and services. You get inflow of precious metals. By buying imports from other countries, you have to pay through precious metals. So what is the solution or the conclusion here? That every country, if it wants to become wealthy, it has to export more than its import. It is as simple as that. So more gold and silver, more precious metal, because when exports are more than it imports, the inflow of precious metals will be more than the outflow of precious metals. That is going to result in a surplus in your economy, and that is going to make your nation powerful. Is the idea of mercantilism clear to you? Is the idea of mercantilism clear to all of you?
Yes, ma'am.
Yes, ma'am.
Okay. So now comes the rational question that mercantilists say that all countries should export more than what it imports. The logical question that comes here is, can this condition hold for all the countries? The answer definitely is no. Because if the wealth of one country has to come from some other country. What do we mean by this? That if I have to export more, there has to be another country which is buying those goods from me. That means its import will be more. If I am importing less from that country, that means that other country's export is less. So, can this condition hold for all the countries? The answer is no, because the wealth from one country must come from somewhere else, is it not? When will I be able to buy something? When somebody sells it. When will I get my income? When somebody is spending. So, when I want to export more, somebody has to be there to buy it from me, or spend or send that outflow of metals from their country into my country. Now the question is, there is a conflicting interest. Suppose all countries say that I only want to export, because by export I'm going to become rich. Is it possible? Is it possible that all countries can follow the same policy, that my export should be greater than imports? Only then I'll be rich. All countries of the world, can they follow this policy? It is not possible, because one country can gain only at the expense of other country, and therefore the mercantilist policy, what they said that there has to be strict government control over the activity to ensure a positive trade balance. That means that all countries should have government interference in the trade. Now remember that we are talking pre-Adam Smith. Okay, Adam Smith's theory has come after this theory, and pre-Adam Smith they proposed not free trade, they proposed government interference in the trade. Okay, so keep this in mind that it was Adam Smith who proposed free trade. But before Adam Smith, when the mercantilist theory was in place, they wanted that there should be strict government control over the economic activity. For what? So that there is export promotion and restriction on import. Okay, so they wanted strict government control for what? They wanted that all the economies should export, promote their exports so that they can earn more, and they should control or have a restriction on their imports so that there is positive trade balance. Exports are greater than imports. So the only role which the government is supposed to have according to the mercantilist theory, what is the only role that the government had? It wanted to stimulate exports and discourage imports. So there was this preaching of economic nationalism. Can you think of the recent Indian policy which is similar to this economic nationalism? Nationalism can be of different types. Na? We say that we are all nationalist, we are all patriots. So economic nationalism is a part of overall nationalism. There can be cultural nationalism, there can be political nationalism. This is economic nationalism. Can you think of any recent economic policy followed by India which promotes economic nationalism? Remember, mercantilists existed in 17th century, and this theory is even today. Economic nationalism
Made in India.
Policy basically say, it says I want to stimulate nations exports, discourage imports, ensure that the goods are made in India, make in India. So a local content they are promoting, they are trying to see that nationalism is promoted through economics. They are saying you buy locally, is it not? So this theory, mercantilism, which was valid way back in 17th century, has got a rebirth in many countries of the world, which we call as neo-mercantilism. Okay, so this theory of economic nationalism, where we are saying that the role of government is to discourage imports and promote exports, has come in a new avatar in many of these countries. In India, we can see it in the form of go local. We are seeing these posters everywhere. Na? Go buy local, buy local. You have to buy local goods, promote production of goods which is made in India. So you can see that Make in India has become so popular that even a company like Boat, which used to buy 100%, that is the entire outsourcing was taking place in China. All the headphones, earphones, etc., they were coming from China, has adopted Make in India policy, and now you see a major shift in their manufacturing. So they are making it in India. So what is happening there? They are discouraging imports, and economic nationalism is catching up. So the last aspect about mercantilism is when we say is wealth of nation only in terms of precious metals. In 17th century, when the mercantilist views came into existence, the answer is yes. The answer is no in the present times, but in the 17th century, when this theory prevailed, is yes. Now, why do we say the answer to the mercantilist is yes? Because at that time, the type of government, the type of nations were very different. Now, basically, this was when less of democracy existed and more of monarchy existed in most of the countries. The rulers were existing, and for the rulers, gold was considered to be very important. Why for the rulers the gold was considered to be very important? Because more gold meant that they can have larger armies. So if you remember, in those times, armies were very important in protecting the sovereignty of the nation, because at that time there was no United Nations, there was no treaty between different countries which was protecting the sovereignty of any country. And that's the reason why India became a colony. Any country can come with a larger army and attack another country, and then it can take over and the gold and important resources of the other country. So for the rulers, what was important? Gold, because gold made them richer and they were able to sustain larger armies, and larger armies enabled them to acquire more colonies. So it was related like that, that more gold means more, that is means larger armies means they are able to acquire more colonies, and when they are going to acquire more colonies, they can businesses, and higher businesses means more growth and employment. So the case in example that we can look at here is how India became a colony in search of gold only. So the traders came to India, they found that lots of spices were existing which they can trade and get money from. They also found that Indians have huge stock of gold, so they came and attacked our country and took charge of all the gold. They built very heavy armies, and when they built very heavy armies, they colonized us, they took charge of the resources, they became rich because their businesses were growing, their economy was flourishing at the cost of the colony. So when we look at the mercantilist point of view here, wealth means precious metals, and precious metals meant growth and employment generation to the economy. But if we consider the modern measures of wealth, we can say that it is not the metals. Precious metals are not the only criteria for wealth. Today, we say that it is goods and services, improvement in the quality of life, standard of living, stock of human capital, man-made natural resources, all this are modern measures of wealth. But in 17th century, when the mercantilists existed, they did not have the notion of modern wealth. For them, it was just the precious metals that was considered to be wealth. So this distinction leads to different conclusion as to how a nation can become wealthy. Okay, so the mercantilists were right in their own view, because at that time metals were important and metals were considered to be wealth of nations. But in the recent times, we cannot say it's just wealth, metals are wealth. we have to say look at goods, services, standard of living, human capital, man-made resources, natural resources, all this also as wealth. So mercantilism has been criticized that it is not possible to be existing over a long that if all countries export is greater than imports, it is not possible to have trade in the world. Everybody cannot be accumulating metals. Somebody has to spend some, there has to be some payments from somewhere. So if we look at the trade, if there are two countries, if we take the model of two countries, here we can say that if one country is exporting more than the other country, that is X is greater than M for one country, for the second country, M will be greater than X. Is it not? So if for me, X is greater than M, for the second, there are only two countries, you and me. If for me, if exports are greater than imports, for you, imports will be greater than exports. Will become a zero-sum game. So, mercantilist view was heavily criticized, saying that trade is a zero-sum game according to mercantilists, and therefore it is not a valid theory in the recent times, because overall there is no gain that is happening in the trade. Okay, if it is a zero sum game, it means that there is no gains or no benefits from the trade. I have already discussed the neo-mercantilism or the rise of economic nationalism in the recent times. This we will revisit again when we do the module 3, when we deal with the tariff and the non-tariff barriers that the economies are imposing in order to protect their trade. So this is about mercantilism. We'll do the trade based on absolute advantage in the next lecture on Thursday. Okay. I hope it has been clear.
Yes, ma'am.
Yeah. Anyone has any doubts? So I gave you two topics for self-reading. Please don't leave it. On Thursday's class, we will continue with the absolute advantage theory. So see you on Thursday in the classroom.
Yes, ma'am. Thank you.
Thank you.